Good morning, everybody. I think we're ready to get started. First of all, thanks everybody for joining and welcome to today's discussion of the top 10 trends that we see in the market structure and technology team here for 2022. Before we go any further, maybe I should wish everybody a happy new year and hope that everybody is happy and healthy and getting ready for a big year ahead. My name is Dan Cornell. I am the head of market structure and the technology practice here at Coalition Greenwich, and I will be the host and moderator today. Couple of items before we get started. If you've got an echo, I think we've all been on these long enough. If you've got an echo, check audio, make sure telephone is selected. That should take care of it for you. Throughout the presentation, if there are questions, please feel free to put them in the question box and we will try to get to them as best as time allows. And if you have questions after the presentation today, please feel free to reach out. We'll have our contact details at the end of the presentation. So before we begin, for anybody that's not familiar with the market structure and technology side of Greenwich, we're a group that's focused on, as the name implies, technology, regulation, macroeconomic or even political changes and how they impact the market structure and market participants specifically. We always say our differentiator is the data that we amass in our research, and that's the basis of our analysis. We like to say that without the data, it's just another opinion. That being said, as we're looking at projections for 22, this might be a little more of an opinion today. So the format today, we're going to have an open panel discussion. I'm very happy to be joined by a number of our analysts on the team. We've got Kevin McPartland here, who's the head of research. We're also joined by Shane Swanson, David Easthope, Brad Tingley, Stephen Brule, and Audrey Blader is on the phone as well. So let's get right into it. We've got 10 items to talk about. We're going to round robin those a little bit, and we're going to start off with, we have a three-letter title to this one called the SEC, where, we say regulators aren't usually a trend in their own right, but in 2022, we think that it might be. So let me turn that over to Shane.
Thanks, Dan. So yes, indeed, the SEC will be, we believe, a trend in its own right. So as everyone has noted over the last year or more, the Gensler administration has been nothing if not active. And the official agenda that they've put out is literally so long and impactful, nearly everyone in the market has to keep an eye on what's been proposed. Again, we've noted we'll see a long string of meetings, whether those are, roundtables, whether they're in person or virtual. There's just going to be proposed rules. There will be opinions placed on those. You're going to have to follow through on that. And it covers the gamut. This is not just it's an equities only thing. This is a fixed income only. It is really across the board and it touches all types of the market participants. Even if we look at just the official annual regulatory agenda, which comes out in the spring and the fall as the agency rule list, that scope is kind of daunting, and just picking and choosing from that long laundry list, you've got potential equity market structure reforms, you have proposals around ESG standard disclosures, non-bank liquidity provider registration, fixed income trading venue oversight, short sale disclosure reforms, security-based swaps regulation, enhanced bond market reporting, and on and on and on. That's literally just a small, and that's the official list. That doesn't include the SEC's focus on enforcement around digital assets, increased scrutiny on stable coins and the like. That's an incredibly broad ambit. And that, of course, means that not everybody's entirely happy with that ambit. And that's even within the SEC itself. We've seen with that agenda, Commissioners Pierce and Rossman came out with their own statement to that effect, that they felt there were areas where the SEC was either not focused enough, such as in capital formation, or areas where they were focused too much, such as on revising recently adopted rules and rules that may have only been in effect for a few months and they're already being revised again. So with a eye on time and knowing we have a lot to get to, all we can really say is the 2022 regulatory agenda is going to be in the spotlight over and over again, and everyone is going to be paying a tremendous amount of attention to it. And if they're not, they're going to be missing the boat. And with that, I'll turn it back over to Dan.
Yeah, thanks, Shane. That's why we have it at the top of our list. Let's move on. 2021 saw a tremendous amount of M&A, and I don't think we could talk about 2022 without looking at that and how that's going to continue. I think we had over $5.5 trillion in M&A, dwarfing the previous record set almost 15 years ago. So with that, we have one called More Blockbuster and Perhaps Unconventional M&A. David, do you want to tackle that one?
Yeah, thanks, Dan, and hello, everybody. Happy New Year. I think that the key word for 2022, Dan, is going to be unconventional. You mentioned there's been a lot of M&A activity last year. We're seeing tremendous amount of consolidation, and consolidation isn't new. We see banks continue to merge with banks. We see asset managers looking for scale and efficiency, merging with other asset managers, and of course, the exchanges, trading venues that we all know and love, they continue to come together to offer more multi-asset class trading and support. And of course, the fintechs themselves, right? With the proliferation of firms, they're going to continue to buy each other in search of scale, in search of efficiency. And I think what's really maybe unique about 2022 is going to be some more unique investment approaches, unconventional approaches as M&A heats up again in 2022. And one example that we think stems or is supported in this area stems from CME's move further into the cloud with a deeper partnership with Google. And what's really notable about that is that Google actually made an equity investment in CME. And we've talked a lot over the years about big tech buying their way into capital markets or partnering their way in, and that time may have fully arrived. And I think we should expect some more unconventional announcements and pairings, in addition to the traditional financial institutions, let's say, buying their way into digital assets. So examples of that would be Cboe and ErisX. We will see crypto firms using their capital to buy traditional financial firms. And I think that goes beyond just the acquiring the licensing, let's say for derivatives clearing or running a derivatives markets. I think it's going to go beyond the acquisition of licenses to more strategic partnerships, unconventional pairings, M&A. And I think 2022 is going to force us to sort of stop thinking only about which big exchange or broker will buy, Coinbase. Rather, what will Coinbase or FTX, continue to buy? What other traditional firms might they look at as we move forward into 2022? So expect more unconventional pairings and expect continued activity and a frothy market.
Yeah, and when we look at M&A in our sort of market structure world, we saw a lot of activity in 2021, and that always leaves an hourglass effect. We've got lots of big firms at one end, you've got lots of small startups on the other, but maybe not so much in the middle. And we don't see that changing. So we have one of our topics here titled "Startups on the Heels of the Incumbents." Brad, do you want to chat to that about a bit?
Yeah, sure. Thanks, Dan. So over the past few years, we've seen a huge wave of consolidation across institutional fintech. And we've seen, these combinations create new powerhouses with unique scale and diversified product offerings. And so we see these startups really starting to rise in 2022. That's not to say that the, incumbents don't have their position, because traditionally they've been, more time tested. But we see the startups really driving forward, particularly in order execution and portfolio management systems, as well as some AI analytics and even some market infrastructure changes as well.
Those were big areas in 2021, so I guess we could see that continue to happen in 2022. So we're at the beginning of the year. You can't really pick up a financial paper where we don't talk about human resource, the chase for capital and human capital, and people moves. And those moves are happening at a rapid pace. We have a topic here called an upgraded workforce that addresses those people moves. Stephen, you want to talk to that a little?
Yeah, I think there are a few things at play here. I mean, first of all, you can't talk about human capital without talking about the pandemic and the shift to hybrid or remote. But I think the focus is really more on the talent and what are firms looking for and what are the employees looking for from the places that they're going to go. And as Dan implied, across the entire workforce, mobility is changing. Why people are moving jobs are changing. We do see a lot of movement from firm to firm, whether you're talking about retail, whether you're talking about financial services. So that just continues to be a trend that we've seen for quite some time. But if you listen to what Dave and Brad were talking about, they're also talking about these new firms that are emerging and trying to disrupt the existing environment. And for a lot of people, especially the young people, that's an exciting prospect. And so what we're also seeing are people contemplating what it is that they want in their job and how do I create wealth going forward. And for a lot of them, going into disruptive crypto firm might be a little more interesting than maybe a more traditional path would have been in the past. So I think from the employee perspective, that's a compelling proposition. Then from the employer's perspective, I mean, we're a very regulated industry. And so if you have expertise in custody and you're then going to talk about crypto custody, that's a skill set that an entrant may need. And so what we're seeing is a nice match of people that are looking to move with the need for some of these new innovative firms to acquire that knowledge base and that talent and that skill set. I think the other way that we think about this, and when we talk to firms that are looking about hiring, we ask about the profile. And maybe a couple of years ago or 10 years ago, we talked a lot about Excel usage and market structure knowledge. We've moved now to data science, data analytics, Python. Those are the skill sets required today because we know we're accessing and making decisions off more data, more complicated data. So how are you as a new employee of a firm going to add value to that firm? It's being able to manage that data as efficiently as possible. And so I think we're shifting maybe from Excel to low code to Python, and the skill sets required to be a success at these firms are going to change as well.
And Stephen, do you think the continuation of work from home, do you think that adds to the sort of ease of transition from firm to firm, and do you think it makes it easier for employees to make that move?
I think it does. I think it gives other options. We've seen a lot of activity in people moving to what are less traditionally financial services focused geographies. That's a horrible way to phrase that, but Arizona, Florida are now attracting a lot of people because you are not tethered to an office, right? The fact that you could separate your front office from your middle office led to outsourcing to offshore locations. Now that you are no longer co-locating with your workers, you are now breaking that tether between a big office building in New York or Chicago or wherever. So I do think that that does provide more flexibility, both the employers to find who they want, to make sure that they can look globally for a skill set, and employees to not be so concerned about the location of the head office.
Yeah, well, look, we've got 6 panels on this call, and one happens to be in the office today, and that's it. So I guess that's right. So let's move on to the next topic, which we call best of breed comes into its own. We don't see anybody working with single providers as much anymore as we used to, as interoperability becomes more and more important. Kevin, what do you think of that, and how is that going to play out in 22?
Yeah, so for the last few years, the research we've been doing, and even some of our trends to watch in previous years have focused a lot on automation. So we know a lot of the market participants, the technology firms, but also the sell side, the buy side firms themselves are really focused on end-to-end process automation, which I think was a shift from 5 or 10 years ago when there was a big focus on just sort of the electronic trading part, where now it's really about the whole process, right? So how do we make that happen? And to your point, very few, if any, firms now are working with single providers where everything is in a nice tight box, where everything is already connected, right? So there's a real strong requirement to make sure all of those different platforms and windows on the desktop can speak with one another. Even some firms that have traditionally sort of offered effectively everything have really opened up their offerings and sort of started to provide more and more APIs. I even find it interesting that sort of API, which really at its heart is a technical term, has become sort of a common part of conversation where people are talking about what APIs they have and sort of what APIs they're offering as a part of their product and service. Really, really interesting. So to move forward with that automation, we need to make it easier for these different systems from often different providers, some internal, some external, to speak with each other. And despite the fact that, if you can believe it, the Fix protocol is 30 years old this year, which I'm sure makes some of us also feel old, really incredible. And Fix changed everything. Fix changed everything, right? I still remember when I was back at JP Morgan in the late 90s, seeing that first order come in, into the system automatically without anybody entering, and how amazing that was. But we've come a long way since then. And so, allowing not just back-end processes to talk with one another, but desktop applications, right, to chat from window to window, we really think is huge and is starting to come into its own. Automation doesn't mean, I think as we've learned over the last few years, automation doesn't mean we don't need people. You're always going to have someone at the controls, watching over the systems. And so that desktop integration is just as important as it has ever been, if not more so. So looking into 22, we do expect sort of broader adoption of more standards in the space. FDC3 is big and has really been growing, right, which sort of is a protocol to help desktop applications talk to each other. I'm sure there will be more. I'm sure there will be new ideas, but in the end, this sort of interoperability is hugely important and something that I think we're finally going to see some good progress on in 2022.
In putting this together, we purposefully avoided a lot of the sort of the buzzwords, right? So you don't see in our top 10 list. We're not showing ESG, we're not showing D&I, we're not showing cloud. But when you talk about cloud, just to touch on it maybe a little bit, how much of that is impacting the this question of interoperability, systems integration? Is it making it easier for firms to make that move?
Yeah, I mean, good point, and no question it is, right? Between Amazon, Google, Microsoft, right? There are so many firms that now have either their data already sitting in one of those public clouds, or they actually have their services, their software services running in those clouds. And so if you are, especially if you're starting a firm from scratch, right? I always think about it as, 20 years ago, you would set a Microsoft Exchange server up in a closet in the office so everybody had email. Nobody does that anymore, right? And largely speaking, the same is true for market data access, for trading systems, for portfolio management, for post-trade processing, right? Again, especially if you have the luxury to start from scratch, you're really going to look to the cloud effectively for everything, because that integration without any legacy systems is just so much easier.
Great, thanks. So like I said, we avoided those buzzwords. We also didn't put in here necessarily crypto, and we didn't put in Bitcoin, but we do have tokenization, and the title here is the tokenization of everything. So it's a pretty broad category. David, do you want to break that down for us?
Yeah, thanks, Dan. I think that is a broad term, and it's definitely probably going to capture people's attention, but I think we'll explain it a little bit here. But I want to go back just and point out that the SEC, as Shane's initial macro theme, is definitely a theme within its own right in digital asset world, crypto world. And 2021 was a year where we saw the institutions really take a greater role and become more pervasive in these assets. And we've demonstrated that the market structure, the trading desks, that's even the technology that's altering the landscape is making it much more friendly to traditional financial institutions, and we expect more in crypto land to see those firms come in. You know, in 2022, what we are expecting is to see is a continued focus on bringing much more broader set of existing financial assets, those assets that we know and love, on chain. And so we've seen historically some assets come on chain like VC, like art. We've seen some tokenized securities as well, but we're really expecting a lot more. And you know, whether they be tokenized investment funds, whether they're bonds that are settling on Ethereum, you know, any and all existing assets, this is really the tokenization of everything. We expect to see much more of that. And I think what's really important about it is not just the asset itself, but what is the asset on chain? What does that really bring? And what we believe is that the on-chain assets bring a lot more transparency, not just recording ownership, but free transfer of that asset. And tokenization can open up these assets to a much wider base of investors, whether they be in the US or elsewhere. And then once you have these assets on chain, of course, the post-trade processes that Kevin was talking about, the legacy issues can be solved. And we can see, you know, much more improved settlement. We'll see a reduction in risk, operating costs. You see some of the fund administration or back office work improve overnight. So you may see a lot of middle and back office people really get on board with this even more as they see their jobs change. You know, Stephen mentioned roles changing, jobs changing. You may see the middle and back office get much more on board with digital assets and not just the front office. And all of this assumes, you know, with tokenization that the regulators either bless this activity or mostly stay out of the way. Neither of those are guaranteed in any stretch. But we do expect, you know, tokenization to really take steam, and all of this is really in addition to all of the DeFi, you know, native crypto activities that should be heating up in 2022 as well. So whether that be, you know, the seeking of yield, new trading strategies, whether you're arbitraging decentralized exchanges and other order books, or you're looking at DeFi as an investable asset class in itself, as well as these really fascinating DAOs or decentralized investments funds that are buying up golf courses or buying up, trying to buy the Constitution. It's all very fascinating, but, you know, tokenization of existing real world assets, I think that's the thing we'll be watching the most.
So do you think it's more on the real world asset side than maybe the traditional side? You know, the conversation of moving to, what do you call it, T+1, T+0. We purposely didn't include that, by the way, as a topic. Does tokenization have an impact on that, or are we still a little bit further away from that, perhaps, than we are from, like you say, something like art?
Our own research shows that people are pretty bullish on reduction in settlement times, whether T+1 or T+0. I think it depends on the asset class, whether it's equities, you know, fixed income, what are we talking about here? But I think that by putting these assets on chain natively, then the settlement is instantaneous, assuming that the transfer meets certain requirements and you have compliance built into the process. You know, this notion of compliance as code embedded into the framework of the blockchain itself. So I think you're going to see an explosion of everything, Dan. I think you're going to see it on the kind of exotic crypto DeFi world, but these native traditional assets that we all trade and know are going to be there more and more. I think you just take the Ethereum, you know, bond settlement in Europe is a good example of that.
And we know that there have been, you know, there have been some prototypes that have actually, you know, DTCC, Paxos, these groups have actually succeeded in doing some of this with traditional assets. So, you know, there is some proof of life out there. It's just how broadly accepted does it become over what period of time?
And also the second, great point, Shane, the second and third order effects of what does it mean to have an asset on chain? Does it mean that certain assets become more useful for collateral, for asset, you know, lending purposes? All these other options and opportunities open themselves up as well when you can isolate those assets on chain.
Fascinating spot to watch. So David, one of the things that you talked about with tokenization is transparency, and we've seen sort of lots of global rules on market transparency come in our research. whether that research is how you choose an asset manager, how you pick a financial advisor, how do you choose a trading partner. And when we ask what the top criteria is, once you get rid of fees, the number one criteria always ends up being transparency, right? So we have a topic here titled Even More Market Transparency. Brad, let me throw that over to you.
Yeah, thanks, Dan. So in 2022, we continue to expect to see more market transparency. I mean, this really dates back to the financial crisis in 2008 and 9, and resulting in significant regulation that made markets more transparent than ever. But now, over a decade later, access to market information definitely has increased dramatically since then, but I still think that there are ways to go. Some of the areas where we're expecting to see more transparency in 22 are ESG reporting standards. We know in Europe that they continue to focus on the consolidated audit tape. And then in the US, regulators are increasingly focusing on enhancing trade reporting standards in the bond market. So, in 2022, we definitely see regulation playing a big role in making these markets more transparent. And, the tools and data that investors will need in order to digest and understand all that data will become even more important.
Indeed, can't disagree with that. So you talk about data. We do have a topic called Market Data Gets Interesting Again. One may say market data is old and boring and has been around forever, but I see that changing in the coming year. We've had some things with alternative data and other things, and that's sort of taken its own path. But we have other things happening in the market data world. Shane, you want to talk about what's happening there?
Sure. And it's always interesting because, as we all know, market data is the lifeblood of trading. And so the importance of it literally can't be overstated. And yet we continue to tweak and play and make changes. And we've had some big proposals that have been flying around now for quite a while from the SEC around the SIP itself. And so the absolute, underpinnings of how the general public looks at market data have been, underway and then been challenged in court. Currently, those are the SEC has staved off a number of those challenges. They're still working their way through the courts, but the SIP governance plan and the market data infrastructure plan are still underway, making their way forward. The SIP operating committee did recently submit proposed market data fees for the enhanced market data under the new infrastructure plan. The most fascinating part of that is immediately after proposing those fees, members of the operating committee, including MEMX, IEX, and FINRA, all came out opposing the proposal that had just come out from the operating committee. So lots of tension around the amount and how those fees were calculated. Industry, of course, very concerned about those fees as well, because if they're not set appropriately at the SIP level, that causes problems across the ambit. So clearly more to come. There'll be the continuing legal challenges across the board, but the great market structure changes and upheavals will continue throughout 2022 just at that level. But there's also other interesting things occurring in the market structure world. We also have changes with IEX itself, has gone from being a no-fee market data exchange to this year they will start charging for market data. Not unusual. They started life as an ATS. Most ATSs don't charge for their market data. They became an exchange. Most new exchanges don't. They're to a point where they feel it makes sense to charge for it. Again, I don't believe they ever said they wouldn't. They just had concerns and challenges to how the other exchanges, the larger exchanges, promulgated their own fees. So they're going to come out with theirs. I think one interesting differential that we've noted in the filing is that their delayed data, normally delayed data is on 15 minutes and it's not fee liable. Theirs is 15 milliseconds. So that's a kind of an interesting differential in a way they're trying to make a change. Another big change or new evolving thing in the world of market data is the PIF network. So PIF has come out, and they are a kind of an interesting crossover between traditional finance and DeFi. It's a network that's collecting and publishing continuous real-time market data on chain, and it's doing it in a sub-second time scale. We've got contributors that are including crypto firms. You have high-frequency trading firms like Jump, Tower Research, HRT, and you also have traditional exchanges like MX and IX. So you have a universe that's actually quite interesting, providing all of this data to this new market data, basically challenger. It's not necessarily a whole new world order. They're not producing market data across every asset. It's not every equity currently. It's not necessarily even every crypto, but it's some of the more it's the more heavily traded equities. It's obviously the more heavily traded cryptos, and their pricing mechanism is interesting. It's kind of a consensus with a standard of with a validity variance. So the way they promulgate their price is rather, solid. You get enough of those contributors out there with these prices where it becomes potentially a challenge to the standard market data providers. Over time, we don't know where it goes, but certainly in 2022, we expect there'll be a lot of eyes on PIF as well as these other changes. So make it, again, an easy way to say market data has become interesting again. It's always interesting, but it's become even more so.
Shane, you talked about the SIP and the regulatory environment around that and opening that up to more of a competitive environment. We really haven't seen a lot. We've heard some announcements, but we haven't seen a lot in terms of competitors gaining share, if you would, in that world. Do you think 22's a year we'll see that, or is that still a build process?
Well, we still have to get the approvals. People have thrown their hats in and said we'd be interested in being a competing consolidator for the SIP, but the final approvals haven't all been, gone through the challenges. I think until that's resolved in court, it's unlikely anyone puts forth the effort to say on their day one. Rather, it'll be we're ready, and most of these firms already have solid, they've got the market data ticker plants. They know how to do it. To become a SIP processor is more administrative and regulatory overhead, which again, some of them already have that embedded as well. So it's that change. It's not so much, in my worldview, the heaviest tech lift, because they already do much more complicated data processing. To do the SIP data, it's a challenge, but it's something that's well within their technological chops. Then it becomes, how do they make sure they do all the regulatory and pricing and billing and all that comes along with it. So that really is how they have to, that's the build, the longer tail. And I don't think anybody's going to tackle that until they know for certain that it's going to be something that's allowed.
And one of the questions comes in, we've seen a couple of acquisitions in that real-time data world. We saw Redline recently, right? Active was out there. So do we think we'll see more of that in 22?
I mean, certainly it's a very competitive space, right? And the tech burden is high to do it very, very well. So, again, I think we were saying we'll see more and more M&A. This is another area that's ripe for that type of consolidation.
Got it. Thanks. I'm going to move on. We can't leave 2021 without talking about the retail investor. And we're going to turn it over to Kevin with something called the Retail Investors Get Institutional Investor Treatment. You want to talk through that?
Yeah, I mean, I don't think retail investors have come into the capital markets conversation in my career like they have over the last 2 years. It's been pretty incredible to watch, really across all markets, right? Equity options, fixed income. It's really everywhere. I think, to use the immortal words of Shane, right? Still the retail investor has never had it better. I know not everyone agrees, but if you really dig into it, it's just incredible the access, we talk about transparency, that holds here too, the technology available to retail investors. I mean, certainly when I started working sort of, in the Wall Street environment, the technology that the institutional investors had was, leaps and bounds what you could get access to in a retail platform. I think even with all of the algorithms and high-speed trading, that exists on Wall Street today, retail investors really just have incredible access, right? Whether it be sophisticated order types or even, even effectively execution algorithms are built into some of these sort of more retail active trader platforms. But it's not just about trading either, right? This is also about, investment selection, portfolio construction, really just heavy duty, AI driven, tell me all of your needs and wants, and we're going to construct a portfolio that will meet your needs, right? Things like direct indexing come into play, right? That's where, as a retail investor, you can effectively have a custom portfolio built and executed for you, right? These are things that institutional investors spent years building, and now you can do it as a retail investor. And not just equities, right? In fixed income, right? There's such a search for yield going on right now that there's some really cool new technology that's doing that portfolio construction on the fixed income side. All of that only now possible because of all of the electronic trading and transparency that we've seen in those underlying institutional markets. So it's really amazing. I think the one other thing I would add is, all of the technology has not lessened the need for and use of sort of human advisors and wealth managers. We see this study after study that we do when we talk to retail, we talk to the advisors themselves, that technology is certainly changing the conversation. But really, in the end, for those advisors that keep up with the times, it's really just enhancing how they can serve clients, how they can personalize those services. So, we really see more of that, and it'll be interesting to see all of these sort of new, I guess we should call them Robinhood accounts, that effect from 2020, 2021, where there's some new wealth built up. As that money starts to come into the advisor community, things could get interesting. Last point, and Shane raised this as we put this document together, it's important to note the SEC definitely is monitoring sort of suitability for institutional investors. I think that'll come in a variety of factors in 2022, whether it be, crypto or just even leveraged ETFs. Obviously, the Bitcoin spot ETF, an endless topic of conversation. Maybe we'll see one of those, but I'm not going to even go there as to when. But so, certainly all of this still on the SEC's agenda. Retail access, retail transparency, super important, but you certainly need to have some controls in place to keep everybody safe.
I got two questions here for you. One is, are we done hearing about GameStop and meme stock every time we turn on the news?
Yeah, well, I mean, hopefully to some extent. Although, I think the positive we should take away from it is, maybe we have a retail investor base that's more engaged, more informed. We want to hope they're being informed by the right sources of news and information. Again, we probably shouldn't go down that rabbit hole. But I think the only thing that's going to stop this sort of really engaged retail investor base from trading, quite frankly, will be a big market crash, right? I mean, we saw that back in 2001, we saw that in 2008. Although even to be fair, in those situations, after the world righted itself, the folks come back in, with some new knowledge and new hopes for the future. So, yeah, retail investors certainly going to continue to be a bigger part of the market.
And then the other question, and I got a strange suspicion here that you're going to kick this over to Shane, is around the same topic, but it's payment for order flow. Lots of stuff happened in the US. It's now taken a bit of a turn and taking its own path in Europe. Where is that going to go in 2022?
I will absolutely kick that over to you.
All right, so I'll give my Shane Swanson version of the SEC disclaimer. These are my own thoughts and not necessarily those of anyone else. So look, the payment for order flow discussion, you have your diehards on both sides of the argument. All I can say is, look, transparency, as we've said before, solves a lot of issues. there is some, concerns that can be addressed there. I am a big believer that, again, the retail trader today never has had it better than they do. Does that mean things can't get better? Of course things can get better. There are tweaks that can be made to the current system that can make it better. Does that mean we should rip out the underpinnings of what they have today and roll the dice and hope that it's not worse? I just find that very unlikely unless, again, there's some sort of smoking gun that comes out that none of us are aware of, and I just don't believe after this many years it exists. So in my view, it's very unlikely that there's some sweeping ban, tweaks around the edges, yeah, possibly changes to what's included in the MBBO, 100%, and should be, right? There's no doubt about that. And calculations, how they can be made better to better reflect reality, of course, but do we make a broad sweeping change where we don't know what the outcome is going to be and where the impact could be very negative to the retail investor? I just don't think that's a very likely outcome.
Great, agreed. So we've got one more topic on the board, and in 2021 wasn't exactly a kind year for the prime brokerage business. So we have a topic that says prime brokerage looks forward, and not the easiest topic, but we're going to kick that over to Stephen.
Yeah, so I think if you did a word association and said prime brokerage 2021, what's the first word that would pop into anyone's mind? And so rightly, it was an important enough incident within the industry that there was a reevaluation, right? And so what does this business mean to me? What does this business mean to my revenue mix? What does this business mean for my ability to attract clients and order flow and all of those services for which you're compensated if you're a sell side? And so I think for a lot of the firms, not all, for a lot of the PBs, like, yes, this is a vital part of our business offering, and we need to figure out how to optimize it for the future and based on what we've seen over the past, X number of months and some of the issues that the Archegos incidents revealed. But I mean, at the end of the day, this combination of provisioning of technology and credit and trading and operations is a really effective way to sell services to the buy side, and a lot of the buy side needs this type of service. And so what we see is the willingness to then think about how you need to push the industry forward and push your PB offering forward. Now, you've got a couple of different ways to approach that. One, to sort of tie back to some of the other conversations, we can think about the new offerings. If institutions get into crypto, then what do I as a PB need to do to earn some revenue off that change? And so we'll start to see some of that model emerge. But then you also have to look inward and say, if you look across the entire industry, capital, balance sheet optimization, these are vital parts of the organization of any financial services institution. And so I think that PBs are going to think about how they provision credit, how they can provision credit, frankly, more efficiently and more smartly to the right customers at the right time. And so, we talked a little bit about, we didn't really talk about the shift from T2 to T1. That's kind of a capital conversation, right? Margin loans, that's a capital conversation. So I think instead of abandoning the business, you think about one, your new offerings like crypto, and two, how do I then build more of a fortress environment around my current offering by thinking about doing more analytics around my credit provision, because I still need to do that. Credit's a valuable resource for my organization. I need to treat it as such, but it's also important for my client base. So how am I going to create a model that allows me to offer that credit in a more risk monitored manner? So I think that's a lot of what we're going to start to see is, again, the provisioning of new products. And I think the other thing to watch is the mix of revenue on the sell side and how that changes between PB, underwriting, sales and trading, M&A. Like, those are the core investment banking activities. And it'll be interesting to see over time how those there are different levels of capital usage across each of those lines of business. It'll be interesting to watch how that revenue mix changes, because I think there could be some of those shifts going forward.
Interesting. Well, thank you. I know we wanted to keep this at 45 minutes. We're right about on. I don't think we have any more questions at this time. So let me thank each of you guys on the panel. Thank you for your participation here, and thank everybody for dialing in and participating that way. If you've got additional questions, please reach out to us. Hopefully you know where to get us, and I would be glad to take those offline. So with that, I will call it a day. I want to say once again, Happy New Year to everybody, and everybody have a good day. Thanks all.
Thanks so much.
Thanks, Paul.